Hello and welcome. You're watching the newsroom right here on ET Now. I am Ajay Sharma. The markets are soft today. About a 500-point cut coming in the Bank Nifty. The benchmarks Nifty and Sensex are also soft. 9100 is being negotiated by the Nifty. Let's see how deep do we go below that mark. But before that, let's also tell you the latest as far as COVID update is concerned. 4.2 million cases have been scaled globally as far as COVID is concerned. 2.8 lakh people have died so far. As far as Indian count is concerned, 70,000 people have been infected in India. About 2,200 have died because of that. Prime Minister Modi will be addressing the nation at 8 p.m. today, and there may be some clues about how we go from here on as far as the lockdown is concerned. Meanwhile, in aviation, 12 flights of Vande Bharat mission will arrive to India today, and Centre has released 6,000 crores for 14 states to fight COVID. Glenmark, on the other hand, have started clinical trials of one of the key drugs, and over 45,000 rail tickets have been booked, almost amounting to 16 crore rupees at the start. Arogya Setu app has been made mandatory for travel by railways. OCI visa stays prevents have return of Indians. Trump, meanwhile, has ruled out negotiating China trade deal, and he's sticking to his ground. And US has allocated $11 billion to revamp testing methodology as far as COVID cases are concerned. Meanwhile, markets are drifting lower, and they have been drifting after hitting almost 9,800 2 weeks back. So let's discuss how the road will be in the medium term. What should your strategy be medium to long term, negotiating one of its kind phases of the Indian economy because of this pandemic? A special voice is joining us on the show. Mr. Unmesh Kulkarni of Bank Julius Baer is here with us. He's the managing director and senior advisor at the Swiss wealth management company here in India. Unmesh, good afternoon, and thank you very much for joining us today. What are you guys making of what's happening in the investing environment? What's your hypothesis for the medium term as far as the market goes? What conversations are you having with your wealthy clients across the country?
See, if you look what has been happening, the equity markets in India and even across the world are a little disconnected from the ground reality. Especially if you look in India, in the month of March, we saw hardly any COVID cases in India. However, the markets fell almost 25% here. And that was possibly because of the fear of the unknown. We saw the global sentiment completely crashing. As against that, in April, when the COVID cases, the graph started going up exponentially, we had markets rallying in India almost by 15%. So there's been quite a disconnect. Now, if you extrapolate a bit further, obviously with this lockdown 1, 2, and 3, there has been a lot of demand destruction in the near term. We see where industries will struggle for consumers coming back and consuming their goods or services. Whether it is in the discretionary spend, I mean, that's the area which is obviously going to be the maximum affected, the whole discretionary spend, as people will possibly not hurry into, spending in the spending again. And primarily because of either loss of income or maybe some loss of jobs also. And overall fear and uncertainty, the mood that is going to be prevailing for some time. So given this, we feel that the growth obviously is going to slide significantly. Globally also, we are seeing likely to see a sharp contraction of growth. In India also, we are likely to see sizable reduction in GDP. And also this will be accompanied obviously by analysts cutting down on various estimates of earnings across companies. Obviously various companies in different sectors might be affected differently. What we think is this markets currently over the next 2-3 quarters, they will need to assimilate a lot of data which is coming out of the economy, and companies also the sort of guidance they give with respect to their consumers coming back. And primarily, we feel that this over the next 6 months or so, it could be a sort of sell on rise market rather than rather prolonged, let's say, bear market and a sell on rise market. So what we are talking to our investors, our clients, is obviously from a long-term perspective, the valuations are quite, and they've come closer to reality and come closer to long-term averages. So from a long-term perspective, these are good times. However, there's no hurry to rush into the market, as there will be a bit of a sideways or range-bound movement and maybe with a downward bias.
Right. Unmesh, a data point from Airbnb initial bookings in US shows that there could be a V-shaped recovery from here on as gradual opening of the lockdown is happening. And opinion is divided here in India as well between businesses as well as strategists. How exactly could the recovery be? What's the research which you conducted tell you about the nature of recovery from here on?
See, different industries may react differently, especially the ones that have been suppressed directly. There may be some pent-up demand which may start surfacing once you open up you withdraw the lockdowns. Obviously, there might be a rush of some consumers in some sectors. But overall, if you see, the trend is still on the contraction side. There's going to be severe contraction of demand per se for various reasons. And we don't think it's going to be easy to, call it a V-shaped recovery. It's possibly going to be a more sort of a prolonged recovery. Obviously, as lockdowns get lifted, things ought to improve slowly, but it will take a few quarters for things to come back. Maybe somewhere around in 2021, we will come back to pre-COVID levels in terms of overall demand and the earnings health of companies. So we think it will be a gradual recovery and more of a U-shaped recovery.
Right. So what should the portfolio approach be, Unmesh, in this kind of a market? For example, people who always invested in a methodical manner in the market, and because of the correction, they got scared and they pulled back. They're holding on to their possessions on an MTM loss basis, but at the same time are not allocating fresh money. What would you tell to this class of investors?
Yeah, I think it's very tempting at this time for investors to move out of equities and book losses and sign out of equities. But I would say that you have to look at it slightly longer term. India as a long-term growth story, one of the better emerging markets. Certainly, the long-term potential is certainly there. What we see something right now is it's a global phenomenon. It's not just particularly related to India. Of course, we are also paying the price in it, and it will affect our equity markets also. What we would suggest is investors at this point of time should stick to their core or strategic asset allocation. Those investors who had, let's say, gone overboard into equities and sort of taken extra positions in equities, given the last couple of years of secular rally that we had, should certainly reassess their portfolios and switch back to their core strategic long-term asset allocation. On the other hand, we find that there are a lot of investors who are also sitting on cash and waiting for, they were waiting for correction. So certainly they should use these opportunities, these falls in the market. I would not advocate chasing the market up, because if it turns to be range bound over a period of maybe 3-4 quarters or so, then you don't want to be chasing the markets up. So stick to your core asset allocation. However, give your investments a bit more time. You have to extend your investment horizon. Don't expect for, you have invested today and don't expect for results to come in next 1 or 2 quarters. Things will be tough, but this will be opportunities. Valuations are becoming more and more reasonable. I think that's something that we were all complaining last couple of years, that valuations were stretched. So we are getting into a zone of comfortable valuations slowly. The near term is still fraught with a lot of uncertainty. So ride out the uncertainty and extend your horizon from 1 year to possibly 2 to 3 years, and you should be making money from your own.
In terms of sectors, we know financials are going through a big pain and the commentary is adverse as well. Same for cyclicals. How have what kind of sectoral analysis have you done versus the earning prospects versus the valuations? What are your bullish and bearish bets based on the sectors?
So let me look at the ones where the pain will be obviously in the near term. And these are the sectors that are concerned with the discretionary spend, especially, where there are high ticket items, for example, autos, housing to some extent, autos, and travel, tourism, etc. I mean, these are clearly something of choice. The consumer has a choice whether to spend or not. These are not the essential consumption. So possibly these are the sectors that will take a hit as consumers decide to stay away for a while because of fear of either losing jobs or maybe reduction in income that they may see, or overall uncertainty and fear that is there in the market. Apart from that, anything to do with cross-border, obviously, trade, travel, tourism, etc., that is going to take a hit because of this overall embargo right now, overall restriction on travel. Apart from that, you will also have issues with respect to infrastructure and capex, etc. The whole manufacturing side, you will see a contraction in demand per se, and therefore capacity utilization will possibly on the lower side. So these are some of the globally, I mean, commodities also could be under a bit of a stress, given that overall production and global demand is going to contract. Moving over to the ones where we feel that there will be opportunities and maybe they can withstand the stress bit better. We are quite positive on the pharmaceutical and healthcare industry, not just because of COVID. Obviously, they do benefit a bit in COVID, but primarily this sector has languished for quite some time, and we see that the sector is turning around, and even the US FDA has been seen to be a bit more lenient or relaxed when it comes now to giving fresh approvals to the Indian pharma companies. So that is one sector that even from a valuation perspective, we feel that this is from a longer term perspective, certainly this is one sector that one can look at. You will also have some companies in essential consumption, FMCG or consumption services that will benefit, and that will possibly be more stable, I would say, instead of benefit. They would be more stable because these are essentially your need items that people will keep consuming even in this sort of slowdown. And apart from that, slowly we will find things improving on, let's say, the companies or sectors that are, or rather the companies that are large in nature with good cash flows and healthy balance sheets. You will find basically these are the leaders in their respective sectors with healthy balance sheets and quality of earnings. These are the ones that should withstand the stress a bit more as compared to the one with weaker margins. Financials will continue to be a little bit under stress because of overall demand and contraction in the economy. They will continue to be a bit under pressure. Of course, valuation-wise, they are becoming a bit more attractive, but possibly it makes sense to wait out a bit there.
Right. All right, Unmesh, we'll let you go on that one. Thanks so much for joining us with your strategy on approaching the markets. That was Unmesh Kulkarni or Julius Baer. But there's